And welcome to the Retire Early, Retire Now podcast. I'm your host, Hunter Kelly, owner of Palm Valley Wealth Management. And today we're going to talk about 4 tax-efficient ways for generous givers to give to their favorite charities, right? And I thought no better way, since this episode is releasing on Christmas Eve, no better way to do this episode than to talk about giving and doing it in a tax-efficient manner, because that's all we're about here is how do we save on taxes? How do we meet our financial goals through investing, savings, and all of those different things. So this is just another way to go about it. And 'tis the season for giving. And that's what we're going to talk about today. So if you like this podcast, go ahead and leave a 5-star review on your favorite podcasting app. And as a reminder, we're on YouTube now. So go to Hunter Kelly CFP, subscribe to that channel, and leave a comment on what your favorite charity is. I'd love to know what charities you give to and why it's special to you. I have a few myself, but would love to hear from you guys. So let's just jump right into it. The first way to give tax efficiently is through what's called a donor advised fund. So what is a donor advised fund? It's a charitable investment account where you can donate and distribute funds to your charities over time. And you're asking yourself, well, what's different than just giving to my charities directly versus using this donor advised fund? Well, what the donor advised fund will do is give you a full deduction for that initial contribution to this account if you itemize in that given year. So if you know for sure there's a particular charity that you give, let's say $50,000 a year to, and you know you're going to do that for at least another 10 years, and you have maybe appreciated stock or lots of cash on hand, things of that nature, you can go ahead and dump, let's call it $500,000 into this account, and you can take a large reduction of income up front instead of having to wait to do that each year. So this can help you itemize. Again, because of the tax law changes back in 2017, it makes it much more difficult to itemize. Most people take the standard deduction. Well, this is one way you can bunch your charitable contributions to potentially itemize every other year. We talked about a little bit last episode using this strategy to do Roth conversions, things of that nature. And so if you're donating things like stock where you have much appreciated stock, then you can avoid capital gains, things of that nature. And so a donor advised fund is one of the more popular ways to donate and take some tax deduction. So how do we go about doing or opening a donor advised fund? So you got to ask yourself a few questions first, right? So what cause do I want to support? How much do I want to contribute initially? And then what type of investments do I want for this fund over time? How do I want it to grow? How often will I give to the particular charity? And do I want my family to be involved? And so once you ask these questions, you can go and research different donor advised providers. And so Fidelity, Schwab, Vanguard, lots of others, but those are the kind of the big main 3. And you can, there's another one called Daffy that's fairly new that you can use as well. And so all these will help facilitate in 1, doing the proper tax paperwork to help you get those deductions, but 2, will go ahead and help you search, find, and then they will send that money directly to the charity of your choice if it's on one of their list of charities as well. And so the biggest thing here is 1, how do you want to treat those investments once you get inside of that account? Do you want it more for short-term giving, long-term giving? And that will help you decide, how do I want to invest this type of money? And then making sure that at the end of the day that you're giving to the proper charity as you would wish, right? And so the next thing you can look at doing for charitable giving that can help with taxes is what's called a qualified charitable distribution. What is a qualified charitable distribution? It's also known as a QCD. And so these are replacing what's called your RMD. So instead of taking your required required minimum distribution out of your IRA when you turn 75, you can actually direct these distributions to a charity of your choice. And so from there, you can take that deduction. Now you're not having to take that income. So how does this help from a tax standpoint? So it counts towards your RMD. So if you need to take a $50,000 RMD, but instead you choose to give that to a charity of your choice, obviously doing the correct paperwork and things of that nature, then you can avoid having to take that RMD as far as those taxes and things of that nature. And then you're contributing to that charity as well. And so a couple things to kind of think about here. If you're a lower income earner on paper in retirement, this can help you preserve credits and things of that nature for Medicare Part B premiums, Social Security benefits, things of that nature. So these can really help long-term for certain credits. And so let's say you're at the RMD age and you need to take a $100,000 RMD. Well, if you don't need that $100,000, that could easily push you up to make your Social Security taxable, bump you up a Medicare bracket where you're paying more Medicare surcharge premiums, things of that nature. And so QCDs, being able to give to your charity instead of taking that minimum distribution, paying taxes on that, can help you from a tax standpoint if you're already charitably inclined. Obviously, you don't want to just give your money away to give your money away, but if you're already giving to your church or some sort of foundation, things of that nature, this can be a good way to keep your taxes either even or reduced, right? It's another way for lower income retirees to maximize their standard deduction. As I said previously, a lot of people do not, or most people do not itemize, right? Because the standard deduction is much higher as of 2017. So this is a way to kind of do your itemized deduction in a way versus having to lump contributions together, things of that nature. So QCDs can be very effective in keeping your income the same or lowering your income. And so give that a thought if you're in that 70 to 75 range, because you're going to have to start thinking about required minimum distributions. The next thing, if you are one of those lucky people that got into a stock early and it has appreciated quite a bit, let's say you have $1 million of Apple that you bought for $200,000 or something of that nature, you can actually give appreciated assets to your charities of choice. You can avoid those capital gains of the appreciated stock and then receive a full fair market value deduction. So how would this work, right? And so if you're a high income earner, this is a good way to, or high net worth. So if you're bumping up against the estate tax thresholds of potentially owing estate tax at your passing, things of that nature, this is a good way to kind of get those types of assets out of your estate and maybe lower it to the point where now your family and your estate does not need to pay those estate taxes. So that's a good way to contribute to your charity, but also avoid capital gains tax as well. The next thing is charitable trust. So you could use a charitable remainder trust or a charitable lead trust. Again, I want to preface this conversation, this part of the podcast episode with, I'm not an attorney. Don't take this as legal advice. These are just ideas. If it seems like it would pertain to you, go ahead and consult with an attorney. They can write up these trusts and things of that nature. And if it's appropriate for you, they would recommend that. I'm not a licensed attorney, but these are just ideas and things that I've seen clients do over my career. So what is a charitable trust? So a charitable trust is usually structured by an attorney and allows you to support your charities while still retaining income from those assets. So what are the tax benefits? Well, you get a partial deduction now while creating a future charitable legacy. And we'll talk about what that means here in just a second. And then you have potential to minimize your estate taxes, kind of like we talked about in the last strategy of the appreciating assets. So let's walk through an example of what a charitable remaining trust would look like, right? So first step would be obviously work with an attorney to get this established, make sure it's the right type of trust you would need or strategy that you need for your situation. And then they would choose or help you choose either a charitable remainder trust or a charitable remainder annuity trust, whatever makes sense for you. So a CRUT would be that charitable remainder uni trust, and it would pay out a percentage of what the trust value is each year, and then you would recalculate what annual income you would get based off that. So if you put $1 million in there, that first year you may get 5% of that, so you may get $50,000. But if that would grow to, let's say, $60,000 the following year, or $1.2 million the following year, maybe you get $60,000, right? And so whatever that math works out to be, the charitable remainder, the charitable remainder annuity trust are generally fixed payouts, maybe over a certain time period, over your lifetime, whatever, however the trust is spelt out in the directions there. And then you would get some sort of fixed payout. So $50,000 a year, $100,000 a year, whatever that may be, right? And so you would designate beneficiaries for that income, whether that be yourself, a spouse, family members, whatever that case may be. And then the charity would receive the remainder of what's left in that trust at that time. And so once the attorney writes all of that up, you would fund that trust with potentially appreciated assets, real estate, stocks, bonds, mutual funds, whatever that may be. And then you would avoid potentially any capital gains. Maybe you have to sell some of those stocks to get into a particular portfolio to meet the need of the income stream that you need. You would avoid those capital gains and then obviously receive that income as well. The trust can sell these assets tax-free, maximizing the amount available for you for investments and then income generation. The next step would be to generate your retirement income stream. So using this trust as income stream in terms of, do you want a percentage of the value or do you want a fixed amount? And depending on your situation, you would consult with the attorney to figure out which one would make most sense, and obviously meeting with your advisor as well. Payments are typically based on the nature of the trust's earning, ordinary incomes, capital gains, return of principal, things of that nature. And so the last step is the benefits of the charity receiving what's left over in there, right? So some tax benefits that you would get a charitable deduction up front. So when you fund that charitable remainder trust, you receive a partial tax deduction based off the present value of the charitable remainder that's in there. And then that would be calculated by IRS tables. And then you would avoid capital gains if there was any appreciated stocks or things of that nature in there, as that goes to sell to meet the income need that you would generate from this trust. And then from an estate planning perspective, you would eliminate some of those assets in there from your estate. So again, if you're one of those people that are worried about paying the estate tax after your death, then this would remove that from your estate, and now maybe that would put you under the threshold, whatever your situation may call for, right? And then after the term of that income, whether that be your death or a fixed term of, let's say, 20 years, anything left in that trust will be going to the charity. So here's a quick scenario or example. So John, 65, plans to retire soon. He owns $1 million of appreciated stock with a cost basis of $200,000. If he sold, the gains obviously would be fairly significant. He would have to pay capital gains taxes on $800,000. So instead, John meets with his attorney. The attorney writes up the CRUT. They fund with that $1 million stock. They sell the stock to meet the investment that they need to produce the annual income. So he avoids capital gains. He receives annual income of 5% in the first year, so $50,000. And if that fund grows, if he increases the value of that, he would increase his payments, right? They would do that calculation every year. He would get a tax reduction. He receives an immediate partial charitable deduction, reducing his taxable income for that year. So maybe he can do some Roth conversions on different accounts that he may have already, things of that nature. So that all kind of plays in there. And then he'll support a charity at his passing that he wants to give to. So lots of different information here. Bunch of different ways that you can give charitably and reduce your taxes. Again, I thought this would be a good topic as we are in the giving season. It is Christmas Eve, so for those that celebrate, Merry Christmas, and Hanukkah starts tomorrow as well, so happy Hanukkah for those that celebrate the Jewish holiday. But if you like this podcast, go ahead and share it with a friend, leave a 5-star review, and get on YouTube and tell me what your favorite charity is. Would love to hear about it. And we'll see you next week. This podcast is for educational purposes only. It is not meant to be legal advice, financial advice. Please do not make decisions solely based off of this podcast. Please meet with legal, financial, tax, or insurance professionals about your particular situation. Please keep Palm Valley Wealth Management in mind when making those considerations.